Hello and welcome back to The Note, and the new year could scarcely have started any worse if you're on the markets. More than $1 trillion written off the market capitalization of the S&P 500 here in New York, and the action was really on the other side of the world. This is the salient chart, I think, to demonstrate why people got so scared. It shows you both the progressive fall of the Shanghai Composite stock index during the week, abetted by technical factors such as rather misguided circuit breakers, attempts to intervene to stop selling. You did see, however, that was of some encouragement that the market steadied itself somewhat on Friday, albeit amid much volatility. Perhaps more importantly, you saw the currency devalue in ways that people hadn't expected throughout the week. There was no really clear signal that the authorities were trying to arrest that decline either. The devaluation is still really very modest in the great scheme of things, but the signal that people think they can perceive from the Chinese, both of what their intentions might be and also perhaps more worryingly whether they are totally in control of circumstances, worried people immeasurably. The next critical point comes here. The fall in the crude price has actually intensified to start the new year. Brent down more than 10% for this year so far, down more than 70% from its peak in 2014. That's despite the geopolitical concerns such as the spat between Saudi Arabia and Iran, the kind of thing that would normally help push the price of oil up. Both the worries about China and the sense that inventories are too high here in the States have been enough to really push oil further down, and that has a bad effect on sentiment across the world. Now, what is very intriguing is that almost forgotten among all of this, today, on Friday, we had non-farm payroll data for the US, normally critically important. As we can see from this next chart, the unemployment rate continues to be at a very healthy level, more or less full employment at 5% there. Further, you could pretty much call this Goldilocks, not too hot, not too cold. It's not continuing to decline. We're not seeing very sharp increases in employment that might force the Fed to tighten quicker than they otherwise would. This looks as though it's the kind of thing that would be ideal for equity markets. If we now also take a look at average earnings figures, the most obvious way that a strong labour market would feed through into inflation, you can see that earnings are ticking up a bit, which will please many people out in Main Street. It's not, however, accelerating or giving a clear signal that inflation could be picking up yet. So not too hot, not too cold, ideal for stocks. What has happened to stocks here? Well, if we take a look at the S&P, it sold off into the close today. It's had its worst starting week for a year ever, according to S&P. It's re-corrected. At its worst point today, it was more than 10% below its all-time high set in May of last year. For technicians, it also looks as though we have a new death cross. The 50 and the 200-day moving averages are almost identical to each other. When you see the 50-day moving average drop below that long-term trend, that is believed to be a very negative sign. It increasingly looks as though we are at the beginning of a bear market here in the US. Now, in Europe, shares generally fell even more, even though there was actually some quite positive industrial data from Europe. Do I have anything positive to suggest at the end of what has been a horrible week? Well, next week, plainly, we need to look out for what China does next. If the authorities can come up with new measures which calm things down, re-stimulate, that will help. Perhaps most importantly, though, we have earnings season starting here in the US. You would not have seen a fall like this unless people had been very worried about corporate earnings power. You have seen estimates for earnings continued to be written down this week. That does suggest that if we actually get some positive numbers, positive surprises, if we get positive outlooks from companies, that could be enough, given the amount of concern that's now reflected in prices, that could be enough to see something of a rebound. Earnings season often provides that opportunity. But part of the reason people have been selling this week is that with China in the situation it is, with oil prices again putting great pressure on energy companies, there is great fear that earnings could be even worse than currently anticipated. I suspect, apart from developments in China, we need to get used over the next week or two to looking very closely at earnings.